Let's go back in time for a second. Imagine it's 1998. The internet is the new frontier. Tech stocks are going through the roof, and you feel like a genius for investing. That is until the year 2000, when the whole thing just completely implodes. Well, fast forward to today. Doesn't that energy feel, familiar? Except this time, it's all about AI. So is this really a once-in-a-lifetime opportunity, or are we just watching the same movie all over again?
Okay, to really get what's happening now, we have to rewind to the dot-com era. This timeline, it really shows the incredible hype of the late 90s. I mean, the internet was going to change everything, right? But all that excitement, all that overconfidence, it created one of the biggest bubbles in history. And when it burst in 2000, it was brutal. The NASDAQ dropped almost 80%. Less than half of those dot-com companies even survived. It was a really painful lesson that even a world-changing technology can lead to a financial disaster.
And that's where this famous line comes in. It just perfectly captures the feelings so many investors have right now. You can see that same kind of euphoria, that same deep belief that we're in a totally new era. The big question, though, is whether this rhyme is going to have the same ending.
And that, right there, is the crucial question we're going to tackle in this explainer. The answer? It isn't a simple yes or no. But if we look at the forces really at play behind the scenes, we can get a much clearer picture of what might be coming down the pike.
So here's our roadmap. We're going to look at three kind of hidden forces that suggest a bubble might be forming right now. We'll dig into the massive bets tech giants are making, a really strange way money's flowing around the industry, and a hard limit that AI might be about to hit. Then, and this is the important part, we'll get into a practical game plan for your own finances.
All right, let's jump right into our first warning sign. It's all about the absolutely staggering amount of money being poured into this AI arms race, and how it's all concentrated in the hands of just a few massive companies. Get this, the fate of the entire stock market is now basically tied to just 7 companies. The Magnificent Seven. You know them: Amazon, Microsoft, Alphabet, Meta, Apple, Tesla, and Nvidia. They make up about 36% of the entire S&P 500. So what does that mean for you? It means that even if you just own a simple index fund, you're already making a huge bet on their success in AI.
And the size of that bet? It's just mind-boggling. These 7 companies are on track to spend a combined $330 billion on AI in a single year. This spending is so massive, it's actually propping up the economy. Seriously, without it, the US might already be in a mild recession.
So to put that number into perspective, that's more than the entire gross domestic product of countries like Finland or Portugal. The stakes here are just immense. Whoever cracks this technology first stands to gain an incredible amount of power. And these companies, they are willing to spend whatever it takes to win that race.
But wait a minute, where is all this money actually going? And that brings us to our second and frankly kind of bizarre warning sign. A strange circular system that some people are starting to call the AI money machine.
Now, this is a really crucial idea to get your head around. At first, yeah, it looks like a normal business ecosystem, but when you look closer, you see this weird cycle where money just seems to get passed around, which allows every company involved to record it as revenue, and that pushes their stock prices up.
The source material actually uses a perfect analogy to explain this. Imagine I pay you $1,000 to dig a hole. Then you turn around and pay me $1,000 to fill it back in. We haven't actually created anything of value, right? But we both get to book $1,000 in revenue. Now, if our little hole-digging business was valued like an AI company, it could suddenly be worth $40,000, all from just passing cash back and forth.
And that leads to another great analogy, the AI gold rush. You've got NVIDIA selling the shovels, the chips. Oracle is providing the land, the data centers. And OpenAI is digging the quarry, building the models. They're all investing in each other, boosting each other's revenues. But here's the kicker. The actual gold, the massive, sustainable profits you need to justify these crazy high valuations, nobody's really found it yet.
Okay, let's move on to our third and final warning sign, and you'll see how this all connects. This belief in endless AI progress, the one that justifies all this spending, it depends on one key ingredient: data. And we might be running out of it. For years now, AI models have just been devouring every single scrap of public data they can find. Books, articles, research papers, you name it. But experts are predicting that by 2027, AI will have consumed pretty much all of it. We're approaching what they call a data wall. And once AI has read everything we've ever written, where does new knowledge actually come from? This really highlights a fundamental difference between how AI learns and how we learn. AI is processing a finite library of stuff that already exists. Humans, on the other hand, we learn by interacting with the world, by having new conversations, making mistakes, and gaining personal experience. That's a type of data AI just can't simulate, and it raises a huge question about whether AI's rapid improvement can really keep up this pace.
So, with these huge warning signs out there, the giant's gamble, the money machine, the data wall, what are you supposed to do? How do you navigate all this hype and protect your investments? Let's get to the most important part, your financial game plan.
First things first, you have to remember this classic piece of wisdom from the legendary investor John Templeton. Every generation thinks they've found a new era where the old rules just don't apply. And while yeah, there are some key differences this time around, the psychology of a bubble, that tends to stay the same.
And look, this is the main difference from the dot-com era. Back then, you had companies with catchy names, but no real products getting these insane valuations. Today's AI companies have real utility. We use their stuff every single day. Their path to making a profit is much clearer, even if it's not totally proven yet. This doesn't mean it's not a bubble, but it might be a bubble with a much more solid foundation. So, what's the playbook for navigating this thing? It's actually pretty simple. 1. Just keep investing consistently. Set up automatic monthly investments into a broad, low-cost index fund. That way, you're not trying to time the market, which is basically impossible. 2. Focus on increasing your income. A market downturn can be a massive opportunity to buy great assets when they're cheap, and higher income gives you the cash to do it. And 3, focus on diversification. If the AI sector does take a big hit, you want to have other investments in things like real estate or bonds to cushion that blow.
At the end of the day, a bursting bubble doesn't have to be a disaster for you. By understanding the warning signs we talked about, by staying consistent with a smart strategy, and by keeping a level head, you can turn a moment of widespread panic into a powerful opportunity. So the real question isn't if the bubble will burst, but what you'll do when it does. Are you going to be the person who panics or the one who profits?